So now we're doing the statement of profit or loss and other comprehensive income. What is that? We are saying at the end of the financial year, the business will prepare what they call the statement of profit or loss and other comprehensive income to see whether they made a profit or in some unfortunate circumstances they made a what? A loss. All right. So the statement of profit or loss comprises of the trading account, that is from your revenue until your gross profit, and then the profit or loss account, that's from your other income until you get your net profit. All right. So we are saying what comprises of the trading account? It's the what? From revenue until gross profit, right? So now what happens in the profit or loss? We're looking at the trading account first. Under the trading account, we are saying we're looking at what the business trades in. That's what they buy and what they sell. All right. So first we have what we call the revenue. We are saying what is revenue? Revenue, that is your sales minus your sales returns minus your settlement discount granted. Right. What do we mean? We're saying you are selling, right? So maybe you're selling screws, right? So you're selling screws and then you sold screws that were worth 150,000. Right. When the customer arrived at home, he saw that one packet of screws were smaller size screws than the screws that he needed. So the person came back to the entity and returned screws maybe worth 10,000. And we're saying when that person had bought screws, we gave that person a discount of maybe another, let's say 20,000. Right. So we're saying the total amount that we are receiving from those screws from this customer will be the 150,000 minus the 10,000, which gives you 140, minus the 20,000, then you get 120,000. So it's just your sales, what you sold, minus sales returns, what the customer brought back, minus settlement discount granted. What is the discount that you gave the customer? All right. Then after that, we subtract our cost of sales, which will be the cost of selling. All right. Under cost of sales, it's your opening inventory. So we're saying this cost of sales, it's opening inventory plus your purchases minus closing inventory. Alright. So we start with what? Opening inventory. Opening inventory, this is just what? Stock, but the stock that you started the year with. So opening inventory is saying last year you had stock, right, that you did not finish. So now you have that stock that you're starting the year with. Okay. But you see that in some scenarios you find that there is no opening inventory. Why are we saying there is no opening inventory? Because maybe it might be your first year of operations. So if it's your first year of operations, you are saying you do not have any stock. Then we are also saying maybe you sold everything that you had last year. So that means there is no stock from last year. You just starting the year without opening inventory. Okay. After that, we add your purchases. What are we saying your net purchases is? So just like when you're selling, when you're buying also, there is the purchases amount. You're saying the amount that you bought for. There is the purchases returns. You're saying the returns that you did. And then there's also the settlement discount that you received. So what do I mean now? Let's say now you're in the business of what? Of earphones, right? So you bought earphones maybe worth 45,000. And then when another customer came to buy to you, or when you just bought earphones, you saw that other earphones were faulty, like they were not playing. So you decided to return them, and maybe those earphones were worth how much? 500 rand. And maybe in the shop you bought more than 10 pairs of earphones, so they're giving a discount of how much? Of maybe let's just say 1,000 rand. So that means the amount that you paid is how much? It's the 45,000, right? Minus the 500 because you did not pay for the 500 because you're going to return those what? Earphones. Minus the what? The discount that you received. So you're saying 45,000 minus 500, then you get 44,500 minus 1,000, then you get purchases of 43,500. Okay. Then we add expenses that relate to purchases. Let me write that down. You only add here. We add what we call expenses that relate. So we're saying expenses relating to purchases. Right. What do you mean? Expenses relating to purchases, these are expenses that you incurred upon purchasing certain goods. So what's happening? Let's say these earphones, you bought them from outside the country, which is in China. So when you bought them in China, SARS will charge you import duty. So that means this will increase your purchase price, right? Because why? You're gonna pay import duty because you bought those earphones. All right. Then insurance on purchases, you're saying when those earphones are coming from China, coming to your place, you are saying from China to South Africa, you must pay a certain amount of insurance just in case something happens to the earphones. You will be reimbursed on those what? On those earphones. So we're saying insurance on purchases is an expense that related to what? To purchases. Therefore, you're paying insurance so that the goods that you bought, if something happens to them, you still have them. Right? Then you have the carriage or the freight on purchases, which is like a transport cost on what you bought. So for freight on purchases or carriage on purchases, you may be familiar with this. Maybe for example, at OK Furniture, they say you're buying a fridge for 3,000, but with delivery it's 3,750, meaning that the 750 is what? On carriage. So meaning that the total will be 3,750. So you're saying if you don't take the option of transport, you pay 3,000, but if you take the option of transport, you pay how much? 750, meaning that it will be 3,750. All right. So now we are saying any expense that are relating to purchases, you add them to the purchases figure. And the purchases figure, we said, how do you get it? You're saying your purchases minus your purchases returns minus your settlement discount that you received. Okay. Then after that, you subtract your closing inventory. Then you get your cost of sales. So what do I mean? Let me just give you a small example. I'm saying, let's say my purchases was 43,000 and then maybe my closing inventory was 43,500. Okay, my closing inventory was 20,000 and maybe I did not have any opening inventory. So this means that I'm saying my cost of sales will be the 43,500 minus 20,000 and then I'll get 23,500. Meaning that I'm saying my gross profit. How do I get it? Your gross profit, you get it by saying the revenue minus the cost of sales. Right. So here we're saying our revenue is 120,000 and then our cost of sales are what? 23,500. Right. Meaning that you're saying your revenue, your gross profit will be the 120,000 minus the 23,500, and then this will give you 96,500 as your what? As your gross profit. So please note that gross profit is your revenue minus your cost of sales. Your what? Your revenue minus the cost of sales. Right. After that, we have other income that we receive besides from trading. We call it other income. That's what we come and we add here, which is saying it's other income. All right. Under other income, we have what we call credit losses recovered. Credit losses recovered, we're saying what? We are saying this is when a credit loss amount is received. Right. They're saying this is when a credit loss amount is received. What do you mean? A credit loss, you're saying this is when a debtor becomes insolvent or a debtor, a person who owes you, cannot pay you back the money. So under credit losses recovered, you're saying maybe someone was owing you money in 2015. In 2015, that person was owing you money, and now since it's 2020, you've written off the person maybe in 2017 saying, if someone was owing me money in 2015, and then in 2020, you'll be like, this person has been owing me for more than 2 years. I don't think that person will pay me. Then you say, okay, it's fine. I'm no longer going to receive that money. It's an expense to me. I've lost that money. But now, later on in 2020, when you don't expect that you receive that money, the person calls you, can you meet? I'll give you what? Let me give you your money. You're saying that is a credit loss recovered because you're saying that is money that you're not expecting to receive, that you're saying, I'm not going to get the money, but now it's what? It's coming back. So that is other income. Why? Yes, it was owed to you, but You were not expecting to get that money anymore. So you had written off that I'm not going to get that money. And now you are saying I'm getting that money. So you need to record it under your what? Your other income. Okay. Then you have your profit on sale of non-current asset. We are just saying this is when you what? You sell an non-current asset and you make a profit. So we'll do this example just before we do PPE. When I touch on depreciation, I'll explain the process of profit on sale of non-current asset. All right. Then we have what? Rent income or rent received. We're just saying you received rent from what? From a tenant. Maybe you have a building. Okay. Then you have commission income or commission received. Maybe you're working on behalf of someone and you're receiving income. And then you have interest income or received. Maybe someone borrowed money from you and they're receiving income. So we're just saying any expense, written income or received. Sorry, any line item written income or received. That's what you classify under other income. All right. After that, now we subtract our expenses. All right. Now, under expenses, the first expense that you need to put it down is depreciation. Why? Because depreciation, it's not what? It's an expense that is usually not given, so you might what? Forget it. All right. Next is credit loss, which I will explain in full in the next lecture, where I will tell you how to account for credit losses and what to do. And I've put examples here which will make your life easier. All right. Then salaries and wages, which are just saying when you're paying your workers, telephone expense, your cell phone network or the landline, water and electricity, that's just the bill that you're using. Municipality rates, maybe you don't rent your property, it's your property, but you're paying rates to the municipality. Then we have carriage on sales. Carriage on sales, it's an what? It's an expense. All right. Because you are delivering now to the person, that means you incur that expense. All right. Then we have insurance. So in an example on carriage on sales, it's Debonairs. Debonairs, they'll sell you a pizza for 180 rand, and then they deliver the pizza to you for how much? For 180 rand. But they're gonna use a scooter which you use fuel, which is a what? Which will be an expense to them. All right. Then we have insurance. You put it as an expense. Please note that insurance on purchases goes under purchases, which is here, and then insurance, which is just an insurance expense, you record it under expenses. Then you have stationery. You just record, and usually sometimes you need to adjust for what? For stationery at the end. All right. Then you have rental expenses if you're renting. Then you have maybe bank charges sometimes. Right. After that, you subtract your finance cost, which you are saying your interest on something. So interest, you see that in most circumstances there's interest on loan and then there's interest on mortgage. So you just need to calculate that specific interest and then you record it under your finance cost. After that, you get your net profit or loss. So under net profit or loss, you're saying what? You're saying it's your gross profit plus other income less expenses less finance cost. This gives you your what? Your net profit. Alright. So now we'll do an example which is October, November 2018, and then we look at how do you account for statement of profit or loss in an what? In an exam. Alright. Thank you.